Hey guys, welcome back to this channel. This is Akash Sukheja. If you're new to this channel, please allow me to introduce myself. I make videos on the stock markets, marketing and business. I also host Business Nerd podcast where I invite entrepreneurs from various parts of the world and they share their stories to help you guys build your business. This series that I'm doing, which is a stock market series, is where I am sharing my learnings of the stock market to help you guys with your investing journey. The whole purpose of this series is to share my thinking process, my strategies, and my complete execution style in terms of investing. I get the nitty-gritty of how I think of one sector and I connect news flow of that stock to something else. Now, this is just my way of documenting everything. I'm trying to get better at investing and I'm sharing everything for free. I've made a couple of videos on the stock market. If you guys haven't checked it out, please go watch those videos. The last one that I did was probably a few months ago, and I'm going to share why I was quiet for some time. Somewhere around December end, I shared a video and I said that after the tariff war comes into play, it will be a whole different world. Like we'll be entering into a new realm of the stock markets and it's going to be really unpredictable of how we invest in the markets, and that played out really well. Now we don't know who's going to win, who's going to lose. For the last 2 months it was very much unpredictable. Like nobody knew what's going to happen. We were just throwing around opinions and I didn't want to join that group of people who just share opinions without any facts. Now that we have some sort of reassurance from the government side and everyone else, so we can fairly say that we are relatively at the end of this tariff war, at least for India. I don't know globally because US and China are still fighting on that. I have no idea about geopolitics or anything. I'm just concerned about the stock markets. I try to make this video in depth for the stock market community and for people who are very new to investing. I'm going to make sure that I explain everything in a very simple language so that you guys understand and you don't feel overwhelmed that you should, like you don't know enough about the stock markets for you to get started. Now let's revisit what I talked about in the last video, because I mentioned that there are few sectors that are still good in the stock markets. Like this was pre-tariff war. Now we've seen the volatility, it was brutal. We saw crashes, we saw FIs entering the markets, we saw FIs exiting the markets, we saw upswings, downswings, everything in the last 2-3 months. And it's not something that we see quite often, because being in the market for over 10 plus years, like I've been, what is 2025? I think it's been around 12-13 years for me. I've seen a lot of crashes. But like this was one of the worst, I could say. Like after COVID, this was the worst crash that we had. In the last video, I had shared a few ideas. So one of them was OMCs. If you guys were not following the videos, I had talked about oil marketing companies doing well because the crude prices were correcting. I didn't know anything about Donald Trump. I didn't know anything about whether he's bullish on oil, what he's doing. I was just bullish on oil marketing companies because I could sense the oil prices correcting. The oil prices were giving a signal of downturn since a long time. If you don't know anything about like oil, I'll give you a simple idea. Oil marketing companies are basically companies that produce petroleum products like petrol and diesel. So these are the companies that we call oil marketing companies. Like oil corrected from $80 to around 60, 61 right now, which is what, 25% of crash. And I'm really excited to see how oil marketing companies use their excess cash in new capacity, because that is going to be a really big driver for the next coming wave that we have in OMCs. So do check it out because it's going to be very useful from my understanding. And the valuations are also very cheap. Like if you look at all these PSU companies in terms of oil marketing companies, their valuations are very, very, very cheap. I'm not going to name any stocks because I used to do that before, but like since the new rules, I'm not trying to do any sort of stock specific conversation, because then it seems like I'm recommending those stocks. I'm just sharing my ideas on the oil marketing companies, this theme of it. So you guys dig deeper, figure out which stocks works for you, and whichever stocks that I share will just be me explaining how I think of one sector, one news flow, and I connect it to the stock. It's not going to be me recommending any of those stocks, so please consider this as a fair disclaimer. I'm not recommending any stocks in this video. Now, if you look at like since we're talking on OMCs, if you just go on Screener or something and we look at companies like Bharat Petroleum, now you can see it is trading at in a single P valuation, and it's a strong dividend yield company. the new oil minister has cleaned up a lot of government bureaucracy problems that oil marketing companies were going through. For these reasons, I was very bullish on oil marketing companies, and like I said, it offers a strong dividend yield. Now the next is IT. Now this is one area where I struggled. IT was what I had shared the December video that I did. The demand has been sluggish, I'll accept that. I have also looked at the recent commentary by major IT players. We don't know what's going to happen with the US government contracts. I'm staying put. I'm not turning bearish. I'm still overall bullish on IT. But at this point, like I'd say that it's okay if you skip this sector. Now metals, this is one area where I've been very bullish on since last 2 years. In 2023, I made a video on metals. I said that the dollar index is going to come down and we're going to see metal prices going up from there. After that video, most of metal companies went up. Alumina prices touched $800 a ton. The last time we saw alumina prices touching 800 was in 2018. So I think people have missed out on this metal bull run, because this has been going on for the last 2 years, and now we're going to see steel stocks coming back in demand because the government has imposed a safeguard duty of 12%, so that's going to protect a lot of domestic players. Major demand in the Chinese market, in the US market of steel, since they are increasing their supply, they'll probably consider giving out some sort of manufacturing boost, and that's going to support the international prices. Given all the major uncertainties we have in the global markets, Indian markets, which is infrastructure, is still intact. A lot of infrastructure projects are being handed out to major players like L&T, NBCC. So infrastructure is still doing really well in India, and I think metals is a proxy play for infrastructure theme. And the other thing that I want to highlight is China is considering a stimulus package, and if they announce a stimulus package to revive their economy, which is very, very, very likely, consider a massive bull run happening in the metal stocks. This is a very strong possibility that the Chinese government will announce a stimulus package which is going to revive their domestic economy, and that's going to have a tailwind effect for metal index, for the metal stocks. And the other area that I want to highlight about metals is the prices have bottomed out. After this tariffs that were announced on aluminium and steel, metal prices have bottomed out, I think so, at least in the near term, and the dollar index is correcting. There's an inverse relation between dollar index and metal prices. If the dollar index goes down, metal prices will go up. If the dollar index goes up, metal prices will go down. And that's going to play out in this scenario. The dollar index has already come off from 108 to 99 that we have right now. The other theme that I had shared is power financiers. Power is one area which was very, very much in trend in 2023, 2024. There was a euphoria in the power sector, especially in the renewables side, and that's over. Like that's not going to happen again. But the theme still remains intact. The rooftop solar scheme, a lot of these energy companies investing in their capacity, renewables, wind, thermal, all those sector. Nuclear is one where there's going to be a major investment in the Indian markets. And there's going to be a strong demand coming in as well. Like new PPAs will be announced, and like there was a report from Motilal Oswal where they said that we can expect investments of about almost $500 billion in the next decade. So which is a massive amount of investment. And the capacity Indian capacity is somewhere around 466 gigawatts, which will be increase up to 817 by 2030. I'm considering it from a very simple perspective. If I go and look at stock specific, like which company is getting more orders, which company is investing, that would be a very difficult thing for me to do. So I would just focus on power financiers. If major power financiers are like REC, PFC, IREDA and other players, these two or three companies in a broader term will do really, really well in the long term. Now the next is like PSU banks. A lot of major institutions have been pitching on PSUs. Last year was crazy. Like a lot of these mutual funds, hedge funds, institutions, PMS guys, like they were just buying PSUs because PSUs was in trend. And a lot of them lost money because after the PSU euphoria was over, a lot of PSU stocks came down. And now these PSU banks are offering a really, really good value. There's no conversation happening that PSU banks are not run properly and only private players are run properly. Now the ground has been leveled for all the companies in the Indian markets, and they have access to capital. Like they are one of the best. Their cost of funds would be relatively lesser compared to private players. Now that's going to be very important when you look at their NIMs. These are the 5 sectors where I was bullish on: PSU banks, power financiers, metals, IT and OMCs. Let's look at what happened with the tariffs and which sectors were affected. So I did my research. I looked at all the sectors that were affected by the tariff situation, and I tried to understand what were the key commodities involved, like whether it's raw materials, whether it's something that they're selling. This would really help you because I've done a lot of research on this. Now, the first one is textiles. Textiles are very like in a bad place when you look at the tariffs, because their exposure to the US market is 60 to 70%. If you don't have a trade deal with US government, like that's going to be a really bad thing for textile companies. The cotton prices are very volatile due to the supply chain issues. If you have any sort of exposure to the textiles, please really evaluate what that company is doing, understand what their management is talking about the current scenario with the tariff situation, and then make decisions accordingly. Now the auto components, which is somewhere around 30-40% of exposure to the US markets. The one thing that's good about auto components is that the tariffs are already being hit by Section 232, which is steel, aluminum and auto. New tariffs of 25%, 26% won't be affected. And since I was doing a lot of research, I read that almost $1 billion of loss will be seen in the Indian auto component sector. Steel prices have also come down. Since we're talking of auto components, steel prices have also come down. That's going to help a lot of these auto components in their margins, at least for this quarter. So consider this like a positive. Now, pharmaceuticals, that's a big area that even I'm not sure of, because there's no announcement of tariffs for pharmaceuticals. About 40-50% of revenue comes from the US, which is a major market for a lot of these pharma players. Donald Trump has said that he'll be imposing tariffs on pharma, but we don't know how much or when. In terms of oncology products, I feel like Indian pharma players are really well placed, like biologics are well placed, but overall generics and a lot of these CDMO players, they might get some sort of hit in their revenues. IT services, like I said, we don't know how much impact does the large IT have due to government contracts, which is negligible as they have stated. But the US GDP has contracted. That will affect the demand for a lot of these clients that they have. Now, specialty chemicals. Now, that has 20-25% of tariffs, but the exposure is 20-25%. This is a major player that's going to be affected. And specialty chemicals in general, have seen a major decline because their prices have corrected, their supply chain issues. Once we see some sort of relief in like tariffs in the supply chain side, things might cool off and things might do well from there on. Now metals, as I said, 15-20% of export exposure that they have. Metals are somewhat safer, like their exposure is 15-20% on the US market, and their tariff is exempt in Section 232. So they don't have major impact unless the price is correct in the metal side, which is unlikely because the dollar index is coming down, which, like I said, if the dollar index is coming down, the metal prices will go up. So aluminum prices have been down about up to $2,000 a ton, and like I think these prices have bottomed out now. So you can see the live prices of aluminum is $2,383. Now electronics, which is one area which is very in a bad place when you look at tariffs, because Indian electronic components or manufacturers have a major exposure to US. Now that China is out, they are imposing tariffs. India, even though should be gaining from this, won't be able to make up for the losses because of the decline in prices, because of supply chain disruptions, because of semiconductor tariffs, and a lot of these players will see major losses. From my understanding, a lot of these electronic exports and telecom companies will see losses due to uncertain scenario. For the time being, if you have any exposure to electronics, consider it like a warning. Now, marine products. Now this is one area which is although not bad, because if you look at the budget of 2025, the government was focusing on marine products. So you can see after the budget, which was around Feb, the stock has gone up considerably. Although it came down in April, it is back at 900 levels. They might see some decline in the revenues due to supply chain logistic issues, the costs are rising for a lot of these players. So that's going to affect their margins. Now, gold and diamond, one sector which I would consider avoiding completely, because I'm not sure what is it like they have problems with lab grown diamonds. So Weber Global has come off. Oh man, look at the correction in Weber Global. It has come off from 1,000 rupees to 200. So this is how bad the situation is. The business model is very outdated. So I would consider avoiding this space given the gold prices are going up. I know that a lot of people are selling their jewelry and investing in like pure gold. They have exposure of 25-30%. Tariffs could majorly impact them because their polymer prices are coming down. This is one sector which I'd also avoid. Now, machinery. This is one thing that has not seen major exposure, like about 10-15% of exposure. Metal prices are coming down, which is kind of a good sign for machinery companies. So I'm bullish on machinery. If you look at capital goods, a lot of these capital goods companies, infrastructure companies, heavy equipment companies will do well because of the tariff situation, because the domestic market is really good. The infrastructure demand in the Indian markets is not as bad as we are seeing globally. Organic chemicals, about 20-25% of exports. One area where I would consider avoiding. I don't like chemicals is because when I was researching, I found out that a lot of these major players in the Indian markets, they're exporting a lot of these chemicals, because I came across a tweet where somebody had shared that the prices of commodities in terms of chemicals have come down, and I looked at the prices. I looked at which company was manufacturing that. I looked at what was their volume, and I found out that so many companies in Indian markets have exposure to these tariff situation that we have. For example, let's look at baking soda. The prices have come off 40% in the year, and GHCL, which is India's largest soda ash and baking soda producer, has a major exposure. Their revenues come from this product. And then there is Aarti Industries. This is not something that I would be comfortable investing in. If you have investments in like Aarti Industries, GHCL, which is an alarming situation, because if the prices have come down 40-50%, that's a big deal when you look at the revenues. So that's going to affect their operations. That's going to change a lot of their dynamics of investing, new capex. What is the new, if they are coming up with an OFS, because they need some capital for their working capital. So we'll see major changes in these chemicals. I bet that a lot of these OFS that we are seeing right now, we'll see a similar situation in the chemical space. Right now, petroleum products, about 23% of exposure to the US markets. I mean, we are not seeing a lot of major impact on the current account deficit side, because crude prices have come off. The dollar prices are likely to come down further. It has stabilized around 85.5. It went up to 87.5, but it came down 2 rupees. So we are relatively in a safer situation. So petroleum sector is one area where I feel like there's enough safety for the Indian investors. Auto manufacturers. The situation has been different. Tata Motors paused their supply chain to the US, but I think now that the tariffs have been reduced, I think they'll resume. So auto is one area which may not be affected a lot, because I think the situation will be solved for Indian markets. Now, industrial goods, not a lot of exposure, so that's on the safer side. If you have investments in like Cummins India or something like that, so you're still on a safer side. There is still some revenue impact due to supply chain disruptions and the commodity prices, but like that's temporary. What should you be doing in this market? Because every now and then when I share all these data, I get these questions from random people that, now I can't say specifically what you should be doing, but I can say what I'm doing. So I don't know anything about international markets right now, because international markets are not doing well. Domestic markets are really, really good. So I would be focusing on the domestic markets. There are great sectors, like I said, oil marketing companies, PSU banks, power financiers, then there's metals. Now we have another theme coming up, which is like a nuclear. I'm going to share all those ideas as things develop, but domestic market looks really good at this price. The other area that you should look at, if you have any sort of, let's say you have random companies, stocks in your portfolio, how do you assess if it's a good investment or not? Look at some signs. If the promoters are buying in the open market because the prices have come down. That generally states that the stock is cheaper and that the promoters see value in the company since they are buying. Then there is companies with high terminal value. Now when I say terminal value, look at companies that you think will survive for the 10, 20, 30 years. Major blue chip companies in this market will have a high terminal value. So we can say that if a company that is relatively cheaper in the market will have a high terminal value. Now when I say terminal value, it just means that it represents worth of an asset or the cash flow that is beyond a specific period. Usually in DCF, like a discounted cash flow model, we consider 10 years. So anything beyond 10 years is considered as terminal value. So look for the companies that have high terminal value. Like you'll have to do some research on this because like it's not a simple thing to explain. So if you want me to cover this terminal value, please leave a comment. I'll do a separate video on terminal value. The other way to look at it is like look for companies that have not crashed much. Let's say the market corrected 20%. If your company has corrected 10%, so that just says simply that it's a good company. One area that I would recommend investors is don't try to be a contrarian investor in this market because we don't know what's going to happen to the tariffs. We don't know what's going to happen to Indian markets tomorrow if there's some sort of unforeseen situation coming up. So stick to domestic markets, stick to companies where there is a lot of visibility in terms of their future earnings, at least for the next 2 quarters. Like don't go beyond 3 quarters, 3-4 quarters. Look for at least 2-3 quarters and like make an assessment of how things will look. So that's just my understanding of this market. I hope you found this video useful. If you want me to make more videos on something like this, please leave a comment. Let me know what type of videos that you want. If you're not following me on like social media, like do check out my LinkedIn because I've been very active on LinkedIn. I'm sharing a lot of investment strategies, some hacks that I learned along the way. And if you guys haven't checked out my podcast, please go check it out. It is available over here. I'll probably link it here. I've hosted a lot of guests like Guy Kawasaki from Canva. He used to work at Apple. He was in the founding team of Apple. I've hosted guests like Jazz Takhar. I've hosted Alok Jain from Weekend Investing. So go check it out. I will see you in the next one. Until next time, peace.